Hello, I'm Maria Dawes. I'm one of the portfolio managers at Capstone Asset Management. Welcome to another edition of Your Wealth Matters, where today we'll be having a discussion on when is the right time to rebalance your portfolio. Today, I'm joined by my fellow portfolio manager, Janet Hussein. Hi, Janet.
Hi.
I'm excited to be here today. We are discussing a topic we get a lot lately, which is when is the right time to rebalance my portfolio? Perhaps we can discuss some of the pros and cons to rebalancing too frequently or too infrequently. But before I get ahead of myself, let's start with definitions.
Yes, definitions. But I think even before we define what portfolio rebalancing is, we have to discuss what a target asset allocation is. So we'll back up a bit. So when a client first engages with Capstone and becomes a discretionary client, they will have signed off on an asset allocation that we've mutually agreed upon based on their set of unique circumstances. And we refer to that as a client's target allocation or asset mix. But as one can imagine, over time, certain funds may have become a bigger percentage of the portfolio due to relative outperformance, and correspondingly, other funds may have become a smaller percentage of the intended target allocation due to underperformance relative to the other funds within the asset mix. So over time, it is natural that you will start to see this drifting from the intended target mix, and this is normal. But at the same time, we as portfolio managers do need to monitor this drifting and potentially bring the portfolio back in line to its intended target. And that is the concept of portfolio rebalancing. And Maria, there are a few different ways that this can be done, right?
Absolutely. And typically in the marketplace, there are a couple different strategies advisors will use to rebalance the portfolio. And one of them is they might use time horizons, such as monthly, quarterly, or annually, to review the portfolio to bring the investment weightings back into line with the intended target. Another strategy, which is what we at Capstone use most frequently, I would say, is to build in some leeway to the portfolio to make sure that there is a range that is acceptable allocation drift according to the client's risk tolerance. So something like a 5% drift range above and below the target would be what we'd apply to the portfolio. Keeping this range too small is pretty impractical because it's unlikely we want to take the time to rebalance the portfolio if it moves like half a percentage point or something like that. But keeping it too big, such as something like 20% above or below the target, might then materially exceed the client's risk tolerance. So you want to avoid that too. Determining the range of allowable drift is the first step, and then deciding how often we're going to check the portfolio is the second step. At Capstone, we've determined that reviewing the portfolio drift on a monthly basis is a good timeline to ensure that things remain on track. This typically gives us lots of opportunity to capture the moments when we need to rebalance things, especially for those portfolios where we know that the client is quite risk adverse. So Janet, we have a lot of questions from people who say, yeah, but why should we rebalance at all? Sure, I might be taking profits off the table, but shouldn't I let the winners just continue to keep winning?
Right. And this is a great question. And further to this, we recently reviewed a study that showed that if you never rebalance your portfolio during a bull market when things are going great, then this can actually put you ahead of the game, which makes sense because, as you mentioned, you're letting the winners keep winning and not cutting off that momentum, so to speak. But the reverse is also true. If you neglect to rebalance in a bad market, then you typically will have worse performance in the long run. So, how do you strike that balance, especially when no one really knows the future? All our crystal balls are the same.
Yeah, I'd say it's a combination of discernment using our portfolio drift ranges, so such as 5% on either side of our target allocation, like what we talked about earlier, and also very much a matter of knowing the client and understanding their risk profile. Managing the parameters so that they're suitable to the risk criteria is always the most important point, I think.
Yeah, I agree with that. And, for me, I have certain clients who will want to keep letting the winners win, as you said. And even though it may mean their portfolio is off target for a while, but we will touch base and keep short accounts about what is happening to ensure that they're still comfortable. And those clients of mine will tend to have a higher risk tolerance too. And there's also a tax question in there too, because if you rebalance non-registered accounts, there is a tax price to pay, and that can get expensive for those big gaining positions. So we might need to do a bit of tax planning first. So that also becomes part of the conversation as well. And then conversely, I have other clients who perhaps having a lower risk tolerance and they want to take the profit off the table, stay closer to their target allocation. At the end of the day, it's not always black and white, but what's really important is that we're on the same page with regards to client expectations.
So true. And I think other consideration is time, right?
Yes. So how much time does the client have to work with, and how often should we as portfolio managers be reviewing that portfolio? Thankfully, there are no fees when we are buying and selling funds, but usually it also doesn't benefit clients' returns if we were to always rebalance the portfolio, if we were slightly out of line, like 1% or sorry, 0.1%. So we do need to find that appropriate balance. In fact, maybe balance is the theme for today. So rebalancing your portfolio, finding the correct balanced mix for your circumstances, right?
Yes, and it is a big deal in the long run. So hopefully at least this conversation has shed some light on the concept of portfolio rebalancing and what some options are for you. I think the crux of the issue here is determine the right strategy for your risk tolerance and then maintain a disciplined approach.
Yes, investing discipline is so important in the long run. So that's actually all for today's discussion. And of course, we always want to hear your thoughts and your questions. So please help us to make these segments more meaningful to you. And thank you for joining us on another edition of Your Wealth Matters.
Bye.